The Biden administration has unveiled new crypto tax reporting rules. In today's video, I will be covering tips on how to build a winning DeFi ecosystem in 2023. Finally, as the cryptocurrency is positioned to pull out of its doldrums, it is judicious for risk-tolerant investors to watch closely some important coins. Stay till the end of the video, as I will be saying the 2 crypto stocks to watch as Bitcoin stages a comeback. If this sounds like something of much interest to you, be sure to check out this new video starting now. Hello and welcome to our channel, where we talk about the latest updates from the world of cryptocurrencies in general. If this is your first time watching one of our videos, we extend a special welcome to you. We invite you to hit the notification bell so you never miss another video. Now, let's dive in. According to a proposed Treasury Department rule released on Friday, cryptocurrency brokers, including exchanges and payment processors, would have to provide the Internal Revenue Service, IRS, with updated information on user sales and swaps of digital assets. The regulation is a part of a larger effort by Congress and regulatory agencies to tighten down on cryptocurrency users who may be evading taxes. The Treasury Department said a proposed new tax reporting form, known as Form 1099-DA, is intended to help taxpayers identify whether they owe taxes and would allow cryptocurrency users avoid having to perform laborious computations to establish their gains. Brokers of digital assets would also be subject to the same information reporting requirements as brokers of conventional financial instruments, such as bonds, and it would also subject digital asset brokers to the same information reporting rules as brokers for other financial instruments, such as bonds and stocks, according to the Treasury. The definition of a broker, under the plan, would encompass decentralized and centralized digital asset trading platforms, cryptocurrency payment processors, and specific online wallets where users store digital assets. The law would apply to non-fungible tokens as well as cryptocurrencies like Bitcoin and Ether. To aid in the preparation of their taxes, brokers would need to deliver the papers to both the IRS and owners of digital assets. The $1 trillion 2021 Infrastructure Investment and Jobs Act included a section aiming to raise tax reporting requirements for digital asset dealers, which is where the additional regulations come from. It gave the IRS the mandate to specify which businesses qualified as cryptocurrency brokers and to offer forms and guidance for reporting. It also extended reporting requirements for certain cash transactions of more than $10,000 to digital assets. At the time the bill was passed, it was estimated that the new rules could bring in close to $28 billion over a decade. The Treasury proposed that the rules would be effective for brokers in 2025 for the 2026 tax filing season. This is part of a broader effort at Treasury to close the tax gap, address the tax evasion risks posed by digital assets, and help ensure that everyone plays by the same set of rules, the Treasury said in a statement. The plan received a range of responses from the crypto industry. If implemented properly, according to Blockchain Association CEO Kristen Smith, the new regulations could help provide everyday crypto users with the necessary information to accurately comply with tax laws. The proposed strategy, according to Miller Whitehouse Levine, CEO of the DeFi Education Fund, a lobbying organization specializing in decentralized finance, will not boost tax compliance or make filing taxes simpler. Today's proposal from the IRS is confusing, self-refuting, and misguided. It attempts to apply regulatory frameworks predicated on the existence of intermediaries where they don't exist, he said in a statement. The IRS currently requires crypto users to report on their tax returns many digital asset activities, including trading cryptocurrencies, regardless of whether the transactions resulted in a gain. Users are required to make that calculation themselves, and the platforms on which digital assets trade do not give the IRS that information. Furthermore, DeFi platforms have evolved significantly, and their sales pitches are no longer as effective as they once were. The key to disrupting and competing with incumbents in the DeFi market is to target users where their most compelling engagements lie, which is no longer in spot markets and yield farming. Perpetual contracts, or perps, are modified futures contracts that have no expiration dates and allow traders to borrow capital and open leveraged positions on certain assets. They have amassed immense capital and interest from crypto traders, with the combined market capitalization of perpetual exchange tokens currently sitting at over $1.1 billion. Today, a small cast of elite DeFi protocols dominate swaps, lending markets, order routing, and liquidity aggregation. Their volume is staggering, their liquidity is unrivaled, and their user bases are loyal, immense, and growing. Attempting to break into the 2023 DeFi scene by targeting spot markets and swaps is a futile endeavor. However, in a lukewarm market that has been trending sideways at best for the last 2 years and change, perpetual contracts have become a favorite amongst traders who love to swing for the fences. In high-stakes environments, every minute detail matters, and perpetual contracts are nuanced, complicated products, as are the perpetuals exchanges they live on. Margin traders are constantly on the lookout for new features, a slicker experience and interface, support for new assets, and more leverage. Existing DeFi incumbents have nailed down the spot market experience to a T, but on the perpetuals scene, the door is wide open to win over users. Solving pain points for perpetual traders by simplifying process flows, providing a more intuitive interface, and offering a simple, honest fee structure is a golden ticket to onboarding existing traders onto not only a new perpetual exchange but an entirely new DeFi ecosystem. To garner interest from perpetual traders, there are 3 key ingredients to develop the perfect perps. Choosing the right chain, supporting big features users come to expect, providing free educational content, and going above and beyond to do right by users. Once perpetual traders are satisfied with their experience on a perpetual exchange, they become interested in exploring what else its native DeFi ecosystem has in store. If a decentralized platform can offer steep leverage, execute swift liquidations, and command multi-asset liquidity incentives, spinning up a V3 decentralized exchange, DEX, and supporting active liquidity management must be a breeze. This is the path to new user acquisition in the 2023 DeFi scene, with users salivating for the next DeFi giant to set up shop at ground zero and build the next DeFi empire. Now to the big question of the day. What are the 2 crypto stocks to watch as Bitcoin stages a comeback? Please, do not forget to subscribe to our channel and also hit that notification bell to be the first person to get more updates about the latest happenings in the crypto space. Bitcoin, BTC, has been trading within a narrow range in August due to low volatility due to traders going on holiday until Labor Day. However, the price of Bitcoin has recently bounced back from its trough of below $25,500, the lowest level since mid-June, and is now holding above the psychological level of $26,000 over the past 24 hours. The Bitcoin rally is driven by the performance of the tech-heavy Nasdaq 100 stock index, as both tech stocks and cryptocurrencies are considered risky assets. Nvidia Corporation's NVDA current blowout earnings have lifted the mood among investors to place bets on tech stocks and given cryptos, including the price of Bitcoin, a lift. The long-dated Treasury yield has fallen, and growing concerns about a hard landing by the Federal Reserve have put pressure on bond yield. The possibility of a pause in interest rate hikes in the upcoming meetings bodes well for high-risk assets, including digital coins. Interest among financial bigwigs in crypto is likely to push the price of Bitcoin, along with other digital coins, higher shortly. BlackRock, Inc. Block has appealed to regulators to create a spot Bitcoin ETF, while Charles Schwab Corporation SQ is backing a new exchange called EDX Markets. The price of Bitcoin is also dependent on its halving cycles. Bitcoin's halving event is due next year when the supply of the world's #1 cryptocurrency will be lowered, leading to a boost in its price. Astute investors should keep a tab on companies that can capitalize on Bitcoin's current upsurge and growth prospects. Hive Digital Technologies Limited. Hive has a Zacks consensus estimate for its current year earnings growth rate of 72.3%. And Block, Inc. SQ has invested significantly in Bitcoin, with an expected earnings growth rate of 68% and 36.3% for the current and next year, respectively. Now, I'd love to hear your thoughts on this in the comments section. Write us anything down here, we are very eager to read you. Always remember that you are an important part of our community. With that, we come to the end of this video. If you enjoyed it, give the video a like and don't forget to subscribe. This really helps me with the YouTube algorithm. Also share this video to as many people as possible, let's get this news everywhere. If you are a true cryptocurrency fan, don't miss any of our content and don't forget to follow us on our new Instagram account at FactMakeMoney. See you in a future opportunity to talk about the latest news that concerns us all as a community. Thanks for watching.